Welcome to LCD's European Loan Market Video Overview, detailing leveraged finance trends and activity during November 2013. I'm Suchit Gupta, a member of S&P Capital IQ's Leverage Commentary and Data Team, a unit of McGraw-Hill Financial that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe before winding up with themes to watch for in December and early January 2014. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the over 11,000 contacts in LCD's Leveraged Loan Group on LinkedIn, as well as leveragedloan.com and highyieldbond.com, free websites promoting the loan and high-yield bond asset classes. On it, you'll find recent market stats, news and analysis, high-yield and leveraged finance job postings, and online primers that explain key market terms. The links to our websites and to follow LCD's social channels are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. Loan issuance was 5.4 billion euros in November 2013, while high-yield bond issuance was 7.4 billion euros for the month. Secondary markets were up. Loan markets were up 27 bips to close at par 73, while high-yield markets were up 14 bips to close at 105.33. According to JP Morgan High-Yield Research, estimated inflows into European high-yield funds for November are estimated to be 1 billion euros. This brings the year-to-date estimated number to an enormous 6.3 billion euros. S&P European Leveraged Loan Index, the ELLI, was up for November with returns at 1.18%. 4 CLOs priced this month, bringing monthly issuance to 1.62 billion euros and the year-to-date issuance to 6.45 billion euros. Default rates were higher, even though no new issuers defaulted. The actual reason was the overall par amount in the ELLI has actually declined due to repayments. Focusing on the secondary loan market, this chart details the average price of LCD's European Loan Flow Name Composite, a measure of the 12 largest, most liquid loans consisting of 10 issuers since 2002. Even with the massive inflows into credit funds, using the inflows from JP Morgan High Yield Research as a proxy for all credit funds, and the strong new issue calendar for both loans and high-yield bonds, secondary markets were up for both the asset classes. Secondary loan prices closed the month up 27 bips to close at par 73. This is the highest read since July 2007, the beginning of the financial crisis. This next chart details the average price of LCD's European High-Yield Flow Name Composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market was up just 14 bips compared to 156 bips in October to finish the month at 105.33. Bond bids had gone up as high as 105.4 before softening towards the end of the month. Nonetheless, this is the highest read since LCD started tracking high-yield flow names back in 2010. This chart details the monthly return of the ELLI, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. The ELLI was up 1.18% for November, up from the 1.02% seen in October, and this brings the year-to-date return to 8.21% versus 8.7% for the same period last year. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. November was the busiest month for loans since July, with loan volume at 5.4 billion euros, and all these deals found a welcoming response from investors, leading to a slew of hefty oversubscriptions, subsequent scalebacks, price cuts, and increases to the amounts. Umari Kabul, for example, took advantage of market liquidity to increase its loan to 800 million euros from 500 million euros, thereby allowing it to retire considerable chunks of more expensive bond and loan debt. Bond volumes also showed a significant month-on-month increase as 20 issuers hit the market for 7.4 billion euros, up from 5.27 billion euros in October. These deals came from a mix of refinancing candidates such as Tank and Ras, sponsors funding buyouts such as SBB Telemac, and fallen angels such as Finmeccanica. The default rate by principal amount stayed level at 3.1% at the end of November 2013. The default rate by issuer count rose to 5.3% at the end of November on the back of the number of issuers in the ELLI declining rather than an increase in the number of defaulted issuers. Themes to watch for going forward: both the high-yield market and the leveraged loan market are buoyant and are open, with the loan market currently having a slight edge as both investors and banks compete to find paper. Issuers will also look to tap the U.S. market for both loans and high-yield bonds as they look for the best execution. The CLO market is still strong, with 7 transactions still in the pipeline, and anecdotal evidence suggests that managers are seeing inflows into global loan accounts, i.e. mandates to invest in the loan markets on a global basis, in basically both the US and European markets. That brings us to the end of our overview. Hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including U.S. loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cheney. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.